Hi, Sriram. If you could please begin.
Okay. Hi, everyone. Srinivas, can we start?
Yes, please. Yes, please. Thank you so much.
Okay, thanks. Yeah, hi, everyone. Good evening, and I hope all of you are safe. And on behalf of the CFA Society of India, I welcome you all to this webinar titled Indian Financial System's Second Wave of Stress. I introduce myself as Sriram, and I work as part of endowment investment function at Azim Premji Trust, an NGO. A few housekeeping rules to start this session before we get on with it. The webinar is scheduled for an hour, and the expert speaker will speak for about 20 minutes to share his thoughts and to lay out his thoughts on a few burning questions that we all have in mind. Following this, we'll have a discussion for another 15 odd minutes, and then we'll open it up for Q&A. That's the layout. And please remember to fill up the feedback forms once you're done with the session, or you do it. Participants can pose their questions, before the last 15 minutes for me to pose it to them. I'll have to do the job of regrouping questions, so bear with me. Now, and as I open the session, I welcome our expert for the day, Ashish Gupta, who's the Managing Director and Head of Equity Research of Credit Suisse India. He's based out of Bombay, and Ashish has been associated with Credit Suisse since 2009. Ashish has been a time traveler, I would say, in financial markets space, being part of and tracking this Indian banking sector for over 2 decades now, well over 2 decades now. He has lived through many turbulent phases in the markets, from the last NBFC crisis, I'm assuming, and then Asian crisis, maybe the rupee ruble crisis, WTC, global financial crisis, taper tantrum, and now, as a couple of days back, Dr. Subbarao called it as CFC, which is Corona Financial Crisis. So all these days. So, Raghuram Rajan was very famous for his Jackson Hole speech, as he forewarned world leaders on impending global financial crisis ahead of us. So our speaker today is also a man who's actually seen tomorrow. We are back in 2012. He has authored this report. I'm sure many of you would have seen this report on the impending credit crisis. This report was dated in 2012, called The House of Debts, is where he started this, and he kept updating those series of reports over the last months and quarters. And so he's someone who probably stuck to the theme, and he was always he's somebody who could see this coming, way back from those days, in fact. So just to give you Ashish is part of a team at Credit Suisse that's highly and consistently rated well by leading journals like Asia Money, Institutional Investors. Ashish also spent a couple of years on the buy side prior to joining Credit Suisse. And prior to that, he has served as a lead analyst covering banking and financial services and also automobile sectors at CLSA based out of Bombay. Ashish holds a master's degree in management from Mumbai University and is also a CFA charter holder. Hi Ashish, welcome you to CFA Society webinar.
Thank you, Sriram, for all the kind words.
So I'll start with, markets have, I always have a colleague who used to say that markets have got high tolerance for losses, but not so much for noises. Right? Today, we have a deafening noise, from various quarters across the markets. You are someone who could cut through a lot of these swathe, and you saw something like this happening in 2012. Not the Corona crisis, but pretty much the crisis that we were in even before this. So we are in the middle of a significant financial crisis, due to a weak economy and a over-leveraged financial system and housing finance system. Top it up with interbank freeze at this point of time, fragile corporate governance and balance sheets, and a bank failure. So it looks like an Indian financial system was in a perfect storm even before COVID. So where do we go from here, and how different are things as you see from what you saw in 2012? Just give us a walk.
Okay, so maybe if I take this part that how are things relative to when we first started talking about all the stress in 2012, right? And I hope people are able to see the presentation we have shared. So first of all, since 2012, one of the focus areas for us has been the corporate leverage, or should I say corporate over leverage. And the House of Debt report really focused on the leverage in some of the largest conglomerates, corporate groups in India. But if we go wider and look at leverage across corporate India, we have found that over the past decade that has been really alarming. Now, all of us are either CFA students or charter holders, and all of us are familiar with various tools to measure leverage. And in India, typically leverage has been thought of using a debt equity paradigm. But rather than that balance sheet measure, I think the key differentiator for us was that we started using interest cover, which is a more cash flow based measure of leverage. And rather than looking at aggregate interest cover, we sought to look at dispersion. Right. So the very simple measure that's been the framework for our analysis, Sriram, has been what proportion of debt sits with companies with interest cover less than 1. It's as simple as that. And all along since 2012, that has been a big concern. And if you see this chart on top left of this slide, even currently about 43% of debt sits with companies that have interest cover less than 1. Right? And way back in 2012, this number was about 20-22%. It's consistently been going up. But what's been disappointing is that despite the fact that corporate loan growth slowed as companies started to deleverage, we have not really seen an improvement in this matrix. So we are entering this period of uncertainty, this period of economic disruption, with corporate leverage still a big problem, with more than 40% of corporates sitting with interest cover less than 1. If you see the pie chart on this slide, that kind of looks at where do these pockets of over leverage lie. And as you would expect, a lot of this sits in sectors like power, infrastructure, and telecom. Of course, now we have been into this corporate credit crisis for last 5-6 years. So a lot of this stress has been recognized, but unfortunately there is still parts of it that is still to turn NPA. And given the increased vulnerability in an environment like this, you will see more challenges coming up. If I quickly delve into some of these pockets. So for example, if you look at the power sector, with the falling demand even pre the COVID crisis, private sector PLFs had fallen below 50%, and therefore the share of power sector debt with interest cover less than 1 had gone up to about 60%. Steel is one sector actually where over the past 2 years we had seen a big improvement in profitability ever since the MIP regime was introduced. But over the past 2 quarters, as the global commodity outlook weakened, we have again seen a big chunk of steel debt and getting their interest cover again back below 1. As many of us are very well aware, telecom sector in India, because of intense competition and very aggressive bidding in spectrum auctions, is sitting in a fragile space. The sector now has basically just 3 companies surviving, and while there have been tariff increases that have come through, we still believe that some of these companies have unsustainably high level of debt EBITDA. So there are some very large lumpy pockets of stress that are sitting out there. in this. Again, to your question, while a lot of this is similar to what has been playing out over the last 4 or 5 years, I think one big difference in the past 18 months has been that we have started to see the concerns on the leverage of borrowers now start to create a crisis of confidence on the lenders itself, right? And in fact, this got catalyzed after the Island FS incident. And post that incident, we started to see the credit markets significantly differentiating. So if you see the table on this slide, what we try to track is what is the ability of various non-bank companies to raise funding from the wholesale debt markets. So basically wholesale funding excluding the bank borrowings. And really for the simple reading, we have just color coded them green and red and yellow, green being companies who are comfortably able to raise money. And if you just take a glance at this table, you'll see that over the past 2 years, in the first 6 months, so till about September 2018, before the ILFS incident, you had most of the companies having comfortable access to the credit markets. But post that, access to the credit markets has been becoming more and more selective. And what is notable is that even going into this crisis in the last 6 to 8 months, the ability to raise funding has become very selective. So most of the liquidity is going into just 4 or 5 names, and already many of the NBFCs have struggled to raise money from the debt markets. This is the differentiation if we look in terms of just the amount of funding they are raising. But equally notable is the differentiation in terms of the cost at which this funding is available. And if you see this chart on bottom right of the slide, that kind of tracks the CP rates over the past 18 months or so. And you'll see that 18 months ago, the ILFS, virtually every NBFC used to raise funding at about somewhere between 8 to 9%. And since then, while for the better perceived NBFCs, as the central bank has cut rates and added liquidity, the borrowing cost, the CP rates have come down. But for many of the NBFCs, the rate hasn't come down. In fact, for some of them, it's gone up, and some of them have struggled to raise funding in the market. If we look at what has happened more recently, you would see the chart on bottom left that many of the NBFCs, even the AAA names, have seen a spike in their credit spreads over the past month, both because of the credit aversion post the Yes Bank bailout, as well as the COVID-related concerns. So, so what we are saying is that till now, for the past 5-7 years, it was primarily a concern around the borrowers. But unfortunately, as we have gone into this crisis, the concern has come even on the lenders. Right? And the effect of this has been that many NBFCs have been struggling for liquidity. So if you see the chart on top right, aggregate NBFC sector loan growth, which was about 23-24% in FY18, is now in single-digit terms. In fact, if we look on an individual NBFC basis, so if you see the chart on bottom of the slide, you'll see many of the NBFCs that have struggled to raise funding are actually contracting their loan book by as much as 15 to 20% currently. right? Now, so that is the differentiation we have seen in the NBFC space. Uh, Another big pocket of growth in the recent years has been private banks. And within private banks, nearly 45% of incremental lending in the past 5 years came from the smaller private banks, right? And these banks were growing rapidly. These banks were growing at 23-24% CAGR. But after the delayed bailout of Yes Bank, we have seen that the debt markets as well as depositors have started becoming more cautious towards these banks. And if you see the chart on bottom left of this slide, you will see some of these smaller banks have started to see some degree of deposit outflow over the past quarter. And what is notable is that this is happening despite the fact that the premium they are paying on their deposits over other private banks as well as state-owned banks has only increased. So if you see the chart on bottom right, you'll see that most of the larger private banks and state-owned banks have been cutting rates as system is saddled with excess liquidity, but the smaller private banks have either kept rates constant or increased it. So it's now not just NBFCs, but some smaller private banks are also seeing liquidity becoming more of a challenge. And this is starting to reflect on aggregate growth that is being driven from the private sector. So like NBFCs, till about 2019, private banks were growing their loans at about 23-24%. And we expect this quarter that to fall into single digits. And within that, if you see the chart on the right-hand side of this slide, you'll see some of the smaller banks are contracting their loan book, and many of them are barely growing in double digits now, compared to the fact that most of these banks used to grow at 25-30%. One pocket of banking system that has now struggled really for the last 5-6 years has been the state-owned banks. And the state-owned banks loan growth has barely been in single digits, and in fact it's been low single digits. And the reasons, of course, are well known, that many of these banks had capital challenges besides the asset quality issues that came about. And as the public sector banks vacated the lending space, that space was filled up by private sector banks and NBFCs, particularly after demonetization, when NBFCs got a big surge in available liquidity. But now, while we have see challenges coming for both NBFC and private bank growth, we believe, despite the fact that nearly $30 billion of capital has been plowed into the state-owned banks over the past 3 years, their ability to grow is still constrained. While their capital levels are above regulatory minimum currently, this will fall below the regulatory thresholds if COVID leads to increase in NPA more than by a couple of percentage points. Another big challenge is that a large number of these banks are going through mergers where they are going to be internally focused rather than externally focused. So really, the challenge we believe is that in addition to high corporate leverage that we have tackled in the past, we are entering this crisis with issues about the financial system's capacity to lend. The primary credit drivers of the last 3-4 years, which is the NBFCs and private banks, are going to be struggling. So if you see the pie chart on this slide, in the past 5 years, state-owned banks have only provided 15% of credit in the system, right? About 1/3 of the credit has been provided each by private banks and NBFCs, and about 20% credit came from the capital markets, including external borrowing. And all these three are going to be challenged in the current environment. So that is what we need to kind of be mindful of. And as you very aptly mentioned in the beginning, that we are entering this crisis with a relatively fragile financial system, right? The last point I would like to make before we do some Q&A is that when we spoke about the stress in the last 5 years, the source of that stress was just the corporate part of the balance sheet, right? But unfortunately, now given the dislocation in the economy is going to be so large, and so many small enterprises, so many consumers are impacted, we expect there will be material deterioration even in the smaller loans, right? So both the consumer loans and SME loans. And we believe some of the segments that are more vulnerable are segments like microfinance, loans against property, SME business banking loans, and these account for about 15 to 40% of loan books of most of the banks. For many NBFCs, because NBFCs are primarily lenders to the SME space, mean that the confidence of credit markets to them is going to reduce even more. So this is going to be the additional challenge, and I think what markets are going to struggle with, as well as bank managements are going to struggle with, is that there is no real pocket where they can say that this pocket is insulated from stress and we can focus all our energy in growing there, right? Which was the case in the last 5 years. So let me just stop here and maybe take some questions.
Thanks, Ashish, and that was a very informative piece that you gave. But the only thing is, I'm just taking it's a segue to my question, which I was thinking was the subsegment of the market that's been doing very well over the last 5-6 years has been consumer credit, and
yes,
you kind of alluded to saying that, look, that is the last citadel and that's going to be pricked. So you really see this comeback, or where do you see this? For instance, the sector has seen a large influx of money,
yes,
private equity players, fintech players, right?
Yeah.
So has COVID-19 pricked the retail bubble for good, or you think the sector will bounce back faster?
Yeah. So see, frankly, I would not necessarily call it a bubble. Of course, over the past 5 years, the growth in retail credit has been faster than nominal GDP. We have seen different product segments being introduced. But I think we also have to be cognizant of the fact that the place where we started from, right, was a very low threshold, right? So the consumer credit penetration was indeed very low. The second thing is that I genuinely believe that this time around, the retail credit that has gone in most of the cases has gone on back of better information about the borrower, right? Because you have credit bureaus with data about 400 million people. The banks which have been expanding into retail credit have been primarily doing it on their own customer base, and as they have digitized, they've been able to better mine the data about their customers, right? So I won't necessarily call it a bubble, but that does not imply that you're not going to see pain in this sector, right? Because the amount of losses in income, the COVID crisis will happen. The only thing we can say is going to be significant, right? The magnitude is still unknown. We don't know how long the lockdowns will last. But of course, to your point that there were many fintechs also that had come into this space, and everyone claimed to have the perfect algo to drive credit. I think in this time, many of those models will be tested.
Got it. So I remember in 2003, you would have seen Rakesh Mohan refer to something as lazy banking, right? Where
Yes.
banks were characterized by parking about 44% in government security.
Yes.
Are we getting to lazy banking? Sometimes I even wonder lazy banking would be better because at this point of time, had they done lazy banking, we wouldn't have seen government security yields at where they are, or state development loan cutoffs at, let's say, around 8.5 to 9 dispersion.
Yes.
So what's your thought on that? I mean, you really think we'll get to lazy banking, or you think lazy banking itself is wishful at this point of time?
Sure. No, so if you call risk aversion as lazy banking, certainly I think we will have to go there, right? And it is natural from that point of view. So any of us who are portfolio managers, right? So if you see bad outcomes on your portfolio, what is the natural reaction, right? You will pull back on risk in the portfolio. And I'm sure every bank is going to be doing it. And particularly in this environment where there is a whole lot of uncertainty, right? So you are not really going to know about the health of the borrower for another 6 months, right? So of course, the moratorium was much needed, and it was introduced timely by the central bank. But the fact is, with the moratorium now coming in, you're not going to be even willing to rely on the CIBIL data of an individual because he's not having to make the payment. So the CIBIL data will not show any deterioration. So no one will rely on the data for the next 3-4 months. So certainly, I think if you mean by lazy banking that loan deposit ratios will be falling, that will happen.
Got it. So how do you think, what are the sectors that will drive business for banking going forward? How do you think the landscape of banking will traverse over the next few years? And what do you think central bank can do to ensure better transmission? So at this point of time, as we discussed, you see a huge dispersion between what the central bank intends and what the market takes.
See, one thing that has happened in the past 18 months, and I briefly refer to it, is that there's been a crisis of confidence, right? So people are not willing to believe the numbers being put out by certain institutions, right? Now, this got triggered by ILFS because prior to that, people were probably just getting comfortable with the nameplate credit rating that various institutions used to have, right? And after the shock of ILFS, more than the rating, it is perception of the borrower that started driving the behavior of the credit markets. Right? So I think you have to somehow come in and build confidence. The central bank response for the past 18 months has been that if it's a problem of liquidity, you keep flooding the system with larger and larger amount of aggregate liquidity and keep lowering rates with the expectation that at some point of time that liquidity will trickle to all the pockets that seek it. Unfortunately, in a risk-averse environment, that's not how it works. Right. So while banks are sitting with more than enough liquidity, they are not willing to take any additional amount of credit risk. Right. So money is not flowing into pockets where it needs. Now we have already seen central banks across Asia and globally, they have been forced to go in and buy risk assets directly. right? So either the Fed buying SME loans directly, some central banks buying corporate paper, or you coming out with structure that provides credit guarantees for certain kind of loans. So we will need to see that come through from the Indian regulators. Otherwise, particularly in the short run, I don't think risk taking comes back very quickly.
Got it. So it's going to take some time for us to build capacity in banking system.
Absolutely.
Got it, right. So other thing is, I think there's been a lot of question on the risk of rating downgrade. The thing is, two things to it. If I were to say, global policy levers are all resonating easing. Fiscal
Yes.
and monetary policy, both of them are resonating easing going forward.
Yes.
And rating is going to be a very relative scale. So does it mean that it's a good time for us to actually kind of cut our purse string and still get away with the rating downgrade risk?
So certainly, I think no rating agency is going to downgrade us just because we give a fiscal stimulus, right? The question is, what is the size of that stimulus? Is it 2% of GDP, 5% of GDP, or a double-digit percentage of GDP, right? Now, if you look at Japan, Germany, US, all these, even Singapore has gone out and put in stimulus packages which are double-digit percentage of GDP. Unfortunately, I don't think, given the interest rates that we run, given the primary deficit that we run, we will not be able to expand our fiscal deficit by that order of magnitude, right? And but a 3 to 5% of GDP, a kind of increase in deficit, I think we have to assume, and I don't think rating agencies will necessarily take it badly, because as you said, it's all relative. So if that is happening across the board, I think they will accept it.
Right. The other thing is, sometimes we, at this point of time, the prayer seems to be for inflation to get back. So I guess all this competitive easing, which is happening globally, is to get inflation or pricing power back into the system.
Yes.
So much of money is sloshing around, effectively money given for non-productive purposes at this point of time. We need to be very cautious about what we are praying for. Does it mean that, 1-2 years down the line, we could have a hyperinflation with low growth? Is that a possibility that you think
so
we could head to?
Sure. See, if you look at the incidence of hyperinflation, right, what triggers them, right? Now, typically hyperinflation does not get triggered by a aggregate demand, right? Now, what we need is to kickstart aggregate demand, right? And I think if we are able to kickstart aggregate demand, which frankly, even before the COVID crisis was missing in many pockets, I think we would have done well. And that would be a great outcome both from our fiscal as well as monetary policy. I think to the extent that we are not very import dependent, to the extent that our external account is actually in reasonably good shape, and with the weakening commodity prices and particularly oil prices, we'll probably end up having a current account surplus. And also the fact that I think the days of hyperinflation in food may be behind us, right? Because globally we are having excesses in food. Even in India, we have enough both food stock as well as food supply. So I'm not really too worried on hyperinflation at this point of time. I think it's more important to get aggregate demand going. And to the extent low inflation is signaling low aggregate demand, I think low inflation is a worry.
Got it. So discussing on valuations of banks, I've always struggled to understand why do Indian banks trade at such expensive valuations related to the globe. In fact, I've even seen regulators time and again mention about having extraordinarily high NIMs globally.
So I think I'm not convinced that Indian banks' margins are high relative to global peers. And when we compare margins, we should not be comparing margins in regimes that have close to 0% interest rate versus markets where the interest rate is a high single digit, right? And then if you start to look at margins of Indian banks relative to, say, banks in Indonesia, Malaysia, Turkey, Brazil, etc. If anything, Indian bank margins are at the lower end of the spectrum, right? So I don't agree there. As regards the high multiples these banks trade at, I think equity markets really pays and maybe at times overpays for growth, right? And for the private banks, there has been clearly a big structural story of consistent long-term growth as well as growth potential, because you have low credit penetration, so you will have certain amount of GDP growth. On top of it, credit will grow faster than GDP, and on top of that, these banks will continue to take market share of the state-owned banks, right? So every 5 years, state-owned banks lose between 8 to 10% of their market share. Right. So if you put all these three drivers, high nominal GDP growth, on top of it credit growth, and on top of it market share gains from state-owned banks, then you can be confident that these banks can have high growth for a long period of time, which drives their valuations.
Got it. So another thing is about this non-leverage space, Ashish. Like for instance, insurance, asset management companies.
Yes.
Given a lack of credit exposures, could these sectors see a faster bounce back? Primarily because you're going to see a reasonable amount of flush of liquidity and low demand for funds.
I think I don't know about bounce back, but at least they will prove to be a lot more defensive, because I think the underwriting risk in these businesses is not there. So as you know, all the banks and NBFCs are leverage plays and also have underwriting risk, right? So depending on the probability you build in, so if you just have 2 to 3% of loans going bad, you can be writing down your book value by 25%, right? So that kind of risk does not sit into these players. So I don't know necessarily believe that on an upswing they will outperform, but at least in a downswing they will certainly
downside,
outperform.
Right?
Yes.
Got it. Another thing that I want to ask you is, there's one question which has come in, which says, given that your reports are so widely read and followed, not just by buy side as well as by sell side, and also by policymakers and regulators, managements and promoters, a lot of them are actually interested parties and also sometimes even pressure groups. How tricky was it to preserve intellectual integrity?
So, frankly, it's been surprisingly easy. And I think the only caution I have always done is make sure that everything is accurate. And actually, for most controversial pieces, I've never used even my own forecast. And if you're objective, and again, there is enough publicly available data in India, and some of these balance sheets presented such stark reading that just presenting those facts was enough. One doesn't really need to come out and make any forecast. So if it is just factual, then there's a lot less debate that comes.
Got it. So So over the last year or so, there's been a lot of rhetoric to save the economy by saving the borrowers. If you look at it, bailout programs for lenders, bailout programs for end borrowers, retail borrowers, moratorium extended, right? So it's been a while since the system actually thought in the interest of capital providers, which would include lenders and other form of capital providers. So is this ending a kind of tipping point where the system has to mean reward at some stage? Because there's been too much of a compromise. I don't quite think there's any discussion happening on capital providers at all.
So, see, frankly, if you are saving the end borrower, you are saving the lender as well, right?
As well.
So, and in many of these cases, the case for saving the end borrower that's been made has been because there is such large lender exposure, right? So whether you talk about the steel industry package that came through, it came through because there are 2 trillion rupees of steel sector loans that are out there. Real estate sector package that is coming about because there is so much of real estate loans out there. So I don't necessarily think that policy makers are ignoring the lenders.
Capital providers.
Yes.
Second is on, there's been a lot of debates also on regulatory depth in India, surveillance depth in India. To what extent, have our surveillance systems, kept up with the kind of business expansion and complexities in business? Is it time that they probably augment regulatory depth by hiring more people from laterally, to make sure that, these things are deeper?
Yeah, so I think certainly we need to augment it. I don't know what is the best way forward for that, whether lateral hires need to be done, whether more technology used to be undertaken, whether you need to change certain disclosure requirements, whether you need to tighten certain intermediaries and have better governance standards there, whether it's rating agencies or audit, etc. But as I mentioned earlier, for the financial system, the biggest issue is that there's a crisis of confidence, right? And that confidence can be restored only by better supervision and supervisory outcomes.
Sorry. I think one of the most popular questions I'm just seeing here is that banks are already grappling with their own financial positions, and the kind of risk appetite is just not ebbing up.
Yes.
So hence, what sort of policy tools do you really think of, which probably can ensure some transmission? Because the fact is that we are right. I mean, TLTROs have made sure that the benefits of TLTROs have not gone to anything beyond 3, 4 companies or 5 companies across.
Yes. So I don't know if you saw the latest RBI guideline where they have capped investment of LTRO funds maximum to 10% to a corporate.
Right.
Or actually, it's a group, not even a corporate. So they're at least trying to broad base that to not from 3, 4, it at least goes to 10 people. But on a more serious note, I think certainly it is going to be a big challenge. The best policy tool at this point of time is going to be some sort of a credit guarantee framework, because
so we are slowly getting there.
Yeah, no, we are rapidly getting there. We need it now rather than later, because without that, no one is going to be incrementally providing lending into these segments.
Got it. So where do you see, there's been a lot of expansion in SME, MSME loans, and we've also seen a lot of, restructuring given, forbearance given to SMEs over the last so many years, in fact, right?
Yes.
That's also building up for some time.
Yeah.
Are things really reaching a flash point at this point of time in that space?
I think prior to this event happening, I don't think necessarily the risks were rising, because yes, SME sector was going through a period of pain, but SME credit was not expanding. So while consumer credit was expanding, actually most banks and particularly PSUs were reducing their SME exposure, right? But with this event coming through, I think the risks have certainly gone up many notches. While in the past, and we have also been critical of RBI providing forbearances during the 2010 to 15 period, various kind of forbearances and restructuring windows. But now to tide over this current economic crisis, they will have to provide certain additional forbearances and restructuring.
Got it. See, I mean, I've traded bonds for some time in my career. So generally seen that, bond markets are all highly, what do I say, correlated risk. We've never really created depth in that segment. There are questions regarding the SEBI's dictate to make sure, finance minister's dictate to make sure that companies access bond markets for at least 25% of their incremental borrowing. I mean,
yes.
I presume at this point of time, it is off season even to discuss about those things.
Yes. Yeah, I don't think, and somehow I think markets are an imperfect animal, right? So it's very difficult to create a market. You might have all the requisites in play, you might tick all the boxes, but how do you get the markets to function, more depths to come in? So we have seen it occur, right? So if you look at equity markets, for some reason, equity futures market in India took off in a very big way. It's been one of the largest futures market, but option market kind of struggled, right? So I don't really know whether it is something in regulation that is keeping it back, or it is just market not finding its feet.
Got it. Another thing which I want to ask is, we are in a very dynamic kind of environment where a lot of behavioral changes are being tested, or we are testing new frontiers. For instance, in school days, we used to learn that man is a social animal. So I guess that fundamental concept is being tested at this stage. So how do you think, in an environment like this, which is actually so in a state of flux, how do you think a candidate can really skill himself, for a kind of role that he aspires for in the investment services? So what kind of skills he has to build on as a professional?
Frankly, working in a foreign bank, I'll say that these days the most sought after, most openings are in compliance and legal. So you need to make sure you tick all those boxes appropriately. But again, on a more serious note, I think what we have to probably think about is being as flexible as possible, right? We cannot be too siloed, both in our skill sets as well as thinking, right? So the more diverse knowledge we have, I think the better it will hold us in our career.
Got it. In fact, we had a former central banker give a session in the CFA forum just about 3-4 days back.
Okay.
And of course, the question, there is a lot of questions regarding the kind of stimulus required and the kind of thing. Why are we holding back stimulus? So he made a very nice point that when stimulus was given during global financial crisis, a lot of it was given either to stimulate demand or stimulate investments. Whereas at this point of time, we are effectively paying people to stay at home and not produce anything.
Okay.
So that's not the kind of stimulus that probably can really work or function. Ashish, I'm just flooded with questions. Questions ranging from, are we entering a stage of stagflation, right? If credit transmission does not work, will there be a dislocation in the supply side, which can probably, bring us to a hyperinflation with so much of liquidity around?
Sure.
And second is, what would be your prescription for trying to repair bank balance sheets, and where do we go from there over the next about 2, 3, 4 years?
Okay.
These are the two most popular questions that I see. Yes.
Okay. So I think the stagflation question I partly answered when we spoke about hyperinflation. So I think I'm actually not worried about inflation because, as I said, I don't think food as a source of inflation is going to be that problematic, and we are not really importing too much inflation as it is. So I think it is more necessary to stimulate demand and make sure that the economy does not get into a scenario of stagnation. Because if the economy gets into a scenario of stagnation, then your other point about rating downgrades also comes in, right? So the way the rating agencies look at debt levels and fiscal deficit is what is it as a percentage of GDP, right? So if your GDP itself is not growing, if GDP starts stagnating, then a 5-6% deficit becomes more problematic. But if your denominator is also growing, it's less of a problem, right? So over the past decade, we have had reasonably high deficit every year, but because the nominal GDP growth was still there, our debt to GDP number did not deteriorate, and we have never been worried about rating downgrade. So I think we need to make sure that economic stagnation is not something we fall into.
Nominal growth has to get higher.
Yes, nominal growth.
So how will the NBFC models evolve going forward? I remember there's been some discussions about activity-based regulations. So slowly will we move into a system which is more activity-based regulation than entity-based regulations, which essentially means, the kind of arbitrage grab will slowly vanish away. So how will the business models, do you think, evolve?
See, I think if we look at activity-based regulation, and particularly what has happened in the HFC space, right, where the regulation for HFCs was separately carved out to NHB, and they made specific, that tell you clearly it has not worked, right? So I don't think we probably need to go there. Of course, there can be more differentiation in regulation. We have seen even in banking, and different types of banks have come on through. You have small finance banks, etc., payment banks being introduced. So those are some small attempts. But I think the biggest challenge of regulation, and even more than regulation, is supervision, is that you need to raise it to a level that market participants starts to become confident about their counterparties, which probably is not the case right now.
Got it. Another burning question, which is not going to be an easy question for you to answer, is where do you see the NPA trajectory going forward as we come out of this crisis? I guess this is, you need to wear your astrological hat to probably answer this question, I presume.
Yeah. So frankly, this is something I'm unable to answer right now, because we don't know how big the cut in GDP will be there during the period of lockdown. Secondly, when we come out of that lockdown, how quickly the recovery will pan out. And third, of course, big imponderable is what will be the regulatory response, right? So what sort of forbearances will be given, and what sort of stimulus will be given. Again, we have had some disclosures already from a few of the NBFCs and banks, and they have indicated that over the past few weeks, the delinquency rates have already gone up to 2.5 times, right? So that's the only indicator. But again, it's still very early days. So the only thing is we can say that it will be materially higher, right?
So is this time that the central bank also looks at a kind of restructuring, one-time restructuring for a lot of loans? Because I remember even a few industrialists have been asking for it. Real estate sector has actually been asking for it. The one-time restructuring to probably allow that to kitchen sink some of these problems and move on fresh.
No, I think they will need to do that. I don't think the moratorium alone is going to be enough. So because the moratorium expires on 1st June, and very few businesses will have cash flows to in June to be expecting it to be the similar level as what they were in February, right? So you will definitely need another restructuring window.
Right. Another thing is there's been a question on Indian bonds being included in global index. You think it's high time or you think it's ill-timed?
So I don't have a very strong view.
Okay.
I think, thankfully, the low foreign ownership of Indian sovereign debt has protected us at this point of time. So it's always a twin-edged sword. But I do think that now globally, both in equities and fixed income market, there is enough passive investment. So if you are in index, that ensure there is always certain level of appetite for your bonds. So in that sense, it's a positive, but really, I don't think it's material in a meaningful way unless you have capital account convertibility.
Got it. I mean, over the last few years, we've seen commercial real estate has actually, sort of kind of attracted a large amount of money. It has also seen very fine pricings, primarily because there's a reason for things to get better. So you really think that's a space which will probably get tested in a scenario like this?
So I'm not sure there are challenges. Again, a large part of the commercial real estate financing, the lease and discounting model that has gone in, have gone for companies with very strong parentage or MNCs, etc. Right. So yes, there might be some tenants who would be challenged, a few malls, etc. But I'm not sure if that is the meat of the commercial real estate financing that has happened. Right. The meat of it has been all these back offices, etc., where the rentals have been discounted.
Got it. Ashish, thanks so much, but I've not been able to do fairness to these questions. I've got about 127 odd questions. I could regroup some questions on. Okay. I'm reasonably sure, we still have left a lot of questions unanswered. I'm also assuming there are a lot of questions which probably are beyond us at this point of time.
Yes.
I'm assuming we should do this session maybe some more time down the line. We'll have a lot more clarity, hopefully.
Yes, absolutely.
So thank you so much. I'll also request participants to please give a feedback on the link. Kindly request you to kindly click the link and give us a feedback. This will really help shape programs much better. Right? So Ashish, that brings us to the end of the session. Okay. Thank you so much for your valuable time. I'm assuming all of us are actually working beyond office hours. We don't even know what is office hours kind of at this point of time. Yes. So thank you so much. Thank you so much.
Oh, thank you, Sriram. Always pleasure chatting with you. And thanks to all the viewers as well for joining.
Thank you. Thanks.
Thank you.